Hello traders, you're looking at a crude oil chart that just lost 2.13% in a single session. That's more than $2 wiped off Brent in 24 hours of trading. I am Eric from Alpha Market Meridian. But here is what 90% of retail traders are missing. The CFTC just dropped the latest commitment of traders' data, and institutional speculators are quietly pulling chips off the table. Net long speculative positions slipped from 192.3 thousand contracts to 191.9 thousand. Not a crash, not a stampede, but someone out there is trimming high beta exposure at the high water mark. We are sitting at a nexus of three tectonic forces. The UAE has just officially walked away from OPEC effective May 1st. The Strait of Hormuz remains blocked despite a fragile ceasefire. And JP Morgan is whispering about oil at $150 a barrel if that strait stays shut through mid-May. The question today is brutally simple. Are we consolidating before the next leg higher, or did Friday's long upper wick on the daily chart just print the short-term top that sends us back below $100? Stick with me. I'll give you three complete trade plans: conservative, standard, and aggressive, each with exact entry triggers, hard stop-loss levels, and target prices you can execute regardless of whether you're trading WTI futures, Brent CFDs, or the USO ETF. I'm going to say it plainly, crude. Oil is still technically in an uptrend on the daily timeframe, but the short-term momentum has shifted bearish on the 4-hour chart. That puts us in a tension zone, a structural bull versus a tactical bear, and these are exactly the conditions where amateur accounts get shredded. The bull-bear line in the sand for WTI is $100 even. A weekly close below $100 would confirm the breakdown of the 4-month wedge and open a fast path toward 96 to 94. Hold above $100, and the bulls retain control of the narrative. Simple as that. For the next 24 to 72 hours, I expect range-bound action between WTI $100 on the downside and $105 on the upside. We are coiling for a breakout, and the direction of that breakout likely ties to two headlines: the Hormuz ceasefire negotiations and the weekly EIA inventory print coming Wednesday. All right, bring your eyes to the chart in front of you. You're looking at Brent crude currently quoted at 108.78. The session started at 111.39. The high was 112.40. The low was 106.29. That is a range of more than $6 in a single trading day. That's not normal distribution. That's a market repricing something. Now, let's walk through the technical structure layer by layer. Look at your moving averages on the 60-minute chart. You've got the MA5 at 1. $108.77, the MA10 at $108.87, and the MA20 at $108.66. That's a cluster, a convergence zone, within about 20 cents. The price at $108.78 is sitting right inside that cluster, which immediately tells us that the short-term price action has completely lost directional conviction. The moving averages are compressed into a band, and price is whipsawing through them. That is a compression signature. And compression always precedes expansion. Scroll over to the MACD. The indicator is showing negative 0.03. That is a bearish cross to below the signal line. Marginal, not overwhelmingly bearish, but the direction of travel matters. The histogram bars are printing smaller negatives, which suggests the bearish momentum is decelerating, not accelerating. This is not a crash signal. This is a fatigue signal. Next, look at the RSI. The 14-period RSI on your chart is reading 50.49. That is dead neutral. The RSI has dropped from earlier overbought readings near 60 to 61 on the 4-hour view to completely flat here. That tells me the market has neutralized its overbought condition without price breaking down significantly. It has done the work through time rather than price. That's a subtle bullish divergence in structure. Now look at the CCI, your commodity channel index, printing negative 3.7. That's also effectively flat. The MACD, the RSI, the CCI, all three oscillators are sitting in a neutral range, not confirming any extreme momentum in either direction. But here's where it gets interesting. The Williams percent range, the WR indicator, is at 75 on the 10-period setting. A reading of 75 on this indicator means the market is approaching, but not yet hitting, oversold territory. The momentum has been to the downside, but the oscillator is telling us that the selling is losing intensity, not gaining it. Pull it out to the daily time frame now. On the daily chart, you can see the MA5 at 109.46, the MA10 at 109.93, and the MA20 at 109.25. The closing price is below all three of those short-term daily moving averages. That means today's session has penetrated the short-term daily support band, and that is a yellow flag for intraday bulls. But zoom further. The MA40 is at 106.50, and that level aligns closely with today's actual session low of 106.29. So the short-term moving average band between 109.25 and 106.50 is where this battle is being fought. Above 109.93, the short-term trend resumes bullish. Below 106.50, we are testing the weekly moving averages. Look at the weekly chart from your second image. The MA5 on the weekly is at 107.58, the MA10 at 100. $4.56, and the MA20 at 101.28. Price is above all three weekly moving averages. The weekly is still bullish in structure. So what you have is a daily chart that's showing short-term bearish pressure inside a weekly chart that remains technically intact as a bull market. This is the definition of a pullback within an uptrend. Until it's not, now let's talk levels. Based on the data in front of us, here are my exact zones for Brent crude, which is the benchmark in your chart. Immediate resistance sits at 109.50 to 110, which is where the daily MA5 and MA10 converge. A break above 110 reasserts the intraday bullish bias and targets the prior session high at 112.40. Above that, we are looking at 114.67 as the next structural resistance. Immediate Brent support is at 107.50 to 107.14, the area where the daily chart shows a prior consolidation base. Below that, 106.29 is today's low, and that is your must-hold level. A break below 106.30 puts us into the weekly MA support zone near 104.50 to 101.28, and below 100.0, the trend structure changes. For WTI, which typically trades $5 to $7 below Brent right now, the equivalent levels are approximately $105 as resistance, $100 as psychological. And structural support, with 98 and then 96 to 94 as the next downside targets on a breakdown. One technical signal I also want to highlight. The DMI, the directional movement index on your chart, is at 61.19 on the daily. That is a strong reading. Anything above 25 on the ADX confirms a trending market. But here's the critical part. The ADX is high while the DI- and DI+ are starting to converge. That means trend strength is still high, but trend direction has become ambiguous, a setup that frequently resolves with a powerful directional breakout. Let me connect the dots on what just happened, because the news flow over the past 72 hours has been a masterclass in conflicting catalysts. Catalyst 1, the UAE walks from OPEC. On May 1st, the United Arab Emirates officially exited OPEC and the broader OPEC Plus alliance, citing the need for production flexibility. This is seismic. The UAE accounts for roughly 8 to 9% of global crude exports. It's the third largest producer inside the cartel. By removing itself from quota constraints, the UAE is now free to negotiate direct, preferential supply agreements with India and China, the two largest demand centers on the planet. Now here's the paradox that most retail traders are misreading. The market initially spiked on this news. Oil went up, not down. Why? Because a fractured OPEC, in the short term, represents an increase in geopolitical uncertainty. Not an immediate increase in barrels. The UAE can't physically ramp production enough over a weekend to offset a blocked Strait of Hormuz. So the short-term bid was uncertainty-driven, not supply-driven. But the medium term, 1 to 3 months from now, an unshackled UAE means more oil hitting the market, and that is structurally bearish. Catalyst 2, the Hormuz ceasefire. The Strait of Hormuz remains functionally closed despite ceasefire discussions. This single choke point accounts for approximately 20% of global oil transit. The surge in Brent crude prices, according to analysis from the Economic Times, reflects a perfect storm of geopolitical conflict, supply disruptions, and fractured OPEC unity. A ceasefire agreement that reopens the strait would arguably be the single most bearish catalyst possible for crude in the near term. It would release the geopolitical fear premium that has been baked into the price since February. On the flip side, if those negotiations collapse, JP Morgan's $150 target becomes a legitimate probability. Catalyst 3, institutional positioning is telling us something. The CFTC data as of May 1st shows net speculative long positions in WTI futures slipped from 192.3 thousand contracts to 191.9 thousand. An incredibly modest 400 contract decline. This is not a dump. This is smart money not adding to bullish bets at the highs. They are content. To hold but hesitant to increase exposure. The more granular read from Chinese sources indicates that as of April 28, speculative funds held a net long position of 135,501 contracts in WTI futures and options, a reduction of 7,900 from the prior week, or roughly 6%. The short side grew by over 7,000 contracts. So the pace of reduction is accelerating, and the direction of travel is toward reducing exposure, not adding to it. Meanwhile, on the retail side, and this is critical, money flooded into the United States Oil Fund ETF. According to Vandertrack data, retail inflows into USO hit a record $115 million over just 5 trading sessions, surpassing the previous peak during the COVID pandemic in 2020. When retail is buying at records and institutions are trimming, the asymmetry favors a move that punishes the late-arriving crowd. The gold-crude oil correlation, and here's the thread that ties it all together. Gold and crude oil are in an unusual short-term negative correlation right now. Brent above $110 is feeding inflation expectations, which is keeping bond yields elevated, which pressures gold downward. The higher oil stays, the harder it becomes for the Fed to justify rate cuts, and that's gold negative, dollar supportive. If crude breaks down below $100, inflation expectations ease, rate cut probabilities tick back up, and gold catches a bid while oil sells off. This cross-asset relationship is something you need to watch every morning. The DXY factor. The US dollar index has dropped to a 2-week low, which is typically supportive for dollar-denominated commodities like crude oil. However, oil sold off anyway on May 1st, suggesting that supply-side factors, specifically hopes for Hormuz ceasefire negotiations, are overwhelming currency effects for now. 1 to 2 week outlook. My base case is range consolidation between WTI $100 and $105, with a resolution breakout triggered by either the EIA inventory data or a definitive ceasefire announcement. I lean marginally lower on the breakout. The combination of UAE supply coming online, weakening speculative appetite, and the potential for a ceasefire deal creates a bias toward the downside. The risk that invalidates this view: if ceasefire talks collapse and the strait remains blocked, you could see a one-day spike that takes Brent to 120 and WTI toward 112 to 115 in the span of a single session. Coming to trading opportunities, let me give you 3 trade plans built for the compression environment we are sitting in right now. These are designed for Brent crude, but I will give you the equivalent WTI levels as well so you can adapt them to whichever contract or CFD you're trading. Strategy 1. Conservative bounce trade, high certainty, small size. This is the high probability setup for traders who want to wait for confirmation rather than try to catch a falling knife. The setup: you wait for Brent to retest the 107.50 to 107.14 zone, the prior consolidation area visible on the 4-hour chart, and for the RSI on the hourly chart to dip below 40 and then curl back above 40. This dual confirmation signal, price holding horizontal support plus momentum curling, gives you a high certainty entry, long Brent at 107.60, with confirmation from the RSI curling above 40 from below. For WTI, the equivalent entry is approximately $102. Stop loss, 106.20, just below today's intraday low. That gives you roughly $1.40 of risk on Brent. For WTI, the stop sits at 101.20. Logic for the stop: a break below the session low invalidates the bounce thesis. It means sellers have taken control of the intraday order flow. Target 1. 109.25, the daily MA20. That gives you a risk-to-reward ratio of approximately 1.2 to 1. Partial position: take off 50% here. Target 2. 110.50, where the MA5 and MA10 converge on the daily. Risk-to-reward of 1.9 to 1. That's your final target. Invalidation: if price breaks and closes below 106.20 on the 60-minute chart before you get long, this trade is off. You do not buy into a breakdown. This is the kind of trade where you're betting that the compression resolves upward after a support retest, and you're using a tight, logical stop to control your downside. But what if the support doesn't hold? Most traders freeze at that point. They have a plan for the bounce but nothing for the breakdown. That's where strategy 2 comes in. Strategy 2, standard breakdown trade, reasonable risk-reward, the setup. This triggers if we see a decisive 60-minute close below today's low at 106.29. But I want a second confirmation. The MACD on the hourly chart must also signal a bearish extension, meaning the histogram prints a lower low. Without that confirmation, you're vulnerable to a false breakdown and snapback entry. Short Brent at 106.20 on a retest of the broken support level after the 60-minute close below 106.29. For WTI, the equivalent entry is approximately $101. Stop loss, 107.99, above the broken MA20 level and today's consolidation midpoint. That gives you approximately $1.79 of risk on Brent. For WTI, the equivalent stop is at 102.60. Logic for the stop: if the breakdown fails and price climbs back above the consolidation zone and the MA20, the short thesis is invalidated. Target 1. 104.75, the weekly MA10. Risk-to-reward of approximately 1 to 1 at this target. Target 2. 101.28, the weekly MA20. Risk-to-reward of approximately 2.7 to 1. Trailing stop rule: once target 1 is reached, move your stop to entry. You are now in a risk-free trade. Let the market take you to target 2 or stop you out at break-even. This is how professional desks manage breakouts. They know most breakouts fail, so they protect the base and let the winners run when they get them. Invalidation: if the 60-minute close below 106.29 occurs during Asian hours with thin liquidity, wait for the London Open to confirm. Thin volume breakdowns frequently reverse. Now, I know there are traders watching this who want the aggressive play, the high-risk, high-reward setup. I'll give it to you, but I want to be crystal clear about what you're stepping into. Strategy 3, aggressive fade scalp, high-risk, narrow stop, professional only, the setup. This is a counter-trend mean reversion trade designed for future scalpers who can monitor the screen tick by tick. You are betting that the intraday sell-off has overshot and will retrace toward the volume-weighted average price or the daily pivot entry. Long Brent at 107.14. the exact consolidation support level, with a limit order only. No market orders. For WTI, the equivalent is near 100-250. Stop loss, 106.50, just 20 cents below today's low. That is a razor-thin 54-cent stop. You cannot widen this. If you can't trade with a 54-cent stop, this strategy is not for you. The logic is binary. Either the support holds immediately or you are wrong immediately. No middle ground target. 109.50, approximately $2.36 above entry. That gives you a risk-to-reward ratio of roughly 4.4 to 1. That sounds attractive, but it only works if you have the discipline to take the loss instantly when the stop triggers. The win rate on a trade setup like this is low, maybe 30 to 40%, but the math works over a large sample because the wins are big and the losses are small. Warning: this strategy is exclusively for professional risk-takers who accept that they may take 5 to 7 consecutive losses before a winner. If you can't emotionally survive 5 losses in a row, do not trade this. Let me pause here and speak directly about the one thing that separates the accounts that survive from the ones that blow up: position sizing and stop-loss discipline. Crude oil is an instrument that can move $5 in 10 minutes during a headline event, and we are in a headline-driven market right now. Every Hormuz headline, every OPEC statement, every EIA release has the potential to gap price instantly. Rule number 1. Your maximum risk on any single crude oil trade must not exceed 1 to 2% of your total account. If you're trading a $10,000 account, that means your stop loss should represent no more than $100 to $200 of absolute risk. On Brent with a $1.50 stop, that limits your position to roughly 700 barrels, or about 2 to 3 microlot equivalents. That's conservative, yes. But this market is not forgiving. Rule number 2. Do not hold positions through the weekly EIA inventory report on Wednesday unless you are explicitly positioned around that release with a defined event risk strategy. Energy Information Administration data is capable of producing 6 to 8% intraday swings. Rule number 3. Your stop loss is not a suggestion. It is the price at which you acknowledge that your thesis was wrong. Move it only in one direction, toward break-even, never away from price. This is the survival rule. Rule number 4. If you are trading both Brent and WTI, understand the spread. The Brent-WTI spread currently sits at roughly $6, and that spread itself is volatile during supply disruption events. Do not assume the two contracts move in lockstep. Let me wrap this up with one sentence that you should take with you into tomorrow's session. Crude oil is coiling between $100 and $105 on WTI, and the direction of the breakout will likely be determined by the Hormuz ceasefire headline, not by technicals. Today's 2.13% decline is a warning that the geopolitical risk premium can unwind as fast as it built. But until $100 breaks on WTI, or roughly 107 on Brent, the weekly trend structure remains bullish, and dip buyers will continue to buy. Tomorrow's focus. Watch for any overnight ceasefire headlines out of the Strait of Hormuz negotiations. A confirmed reopening drops crude by $5 to $10 intraday. A breakdown in talk sends crude back toward 112 and beyond, and here's what I need from you right now. Hit the comment section and tell me, are you a buyer at these levels, or are you waiting for WTI to break $100 before you even look at a long? Give me your specific bull-bear line in the sand. I read these comments and I'll respond to the best ones. If this breakdown helped you, smash that like button. It tells the YouTube algorithm that you want more content like this delivered to your feed. Subscribe and ring the notification bell because I post daily analysis on 8 assets every single trading day. And the next big crude oil breakout is going to happen whether you're watching or not. This is Alpha Market Meridian. I am Eric. Trade what you see, not what you hope. I'll see you tomorrow.